Rohr here with another early concise highlight on Thursday, May 7th, 2015. It is 6:30 a.m. U.S. Central Time. And we are coming to you a bit early today because there's so much going on, especially in the equities and fixed income, with a minor look at the foreign exchange where the euro and the dollar index are most important. Rest is about as reviewed back on Tuesday. But we are revisiting all the equities and the govies today because there have been so many further volatile developments that it certainly pays to review what is going on there. So, what does all that macro influence mean to the markets? Well, it means, as we noted, with energy prices coming up more strongly than expected and maybe a bit of overly disinflationary expectations in the govies, equities and govies have come down together. You know, back on Monday of this week, the market came up to test last Monday's downside closing price reversal. We know we've reviewed this every day, so it's a bit redundant for people who've been watching these, but you can see how we made a new all-time lead contract futures high by a couple bucks up at 21.19 back on Monday the 27th, but closed lower. That left a downside reversal from 21.1170 with a tolerance of 21.14.5. Right back up into 21.12 on a recovery last week Tuesday, and then the week GDP hit the market. Well, after that whole sell-off back down, slightly below 20.75 to 78, the recovery Friday into Monday took it right back up for a test of 21.12 to 15 area, as we're calling it. But by Tuesday, the market was back under pressure again and has remained pressured, variously breaking 20.97 support. Then, while trying to hold on below it for a while, after Janet Yellen's comments yesterday, broke the 20.90 to 88 support, and then actually eroded below 20.75 to 78 on Wednesday before recovering. However, today, due to additional weak factors, especially rates having been a bit higher this morning in early trading in Europe, the market is down at 20.65. So the next support here was 20.60 to 58, and indeed it has traded down to 20.58 before recovering a bit to 20.65 so far this morning. If it breaks 20.58, then the next significant support is the old 20.40 to 36 that we can't even see on this hourly chart. We'll be covering that on the intermediate term view. But generally speaking, ever since the market got itself in trouble, and we're going to run the vertical cursor now, ever since it got itself in trouble, dropping back below the 2100 and the 2090 to 88, going back to Tuesday, the market has had the hourly MACD out below the lower runaway band, and that spells trouble. That normally means the downside momentum can be maintained. And unless this market can recover back above the 78 to 75 area later today, chances are it remains in trouble. And that pretty much does it for the short-term view of the S&P 500.